I am not controlled by any government or bank, yet I can make you rich or leave you in the dark. I've been called risky, volatile, and new, but many believe I'll change what money can do. What am I? The answer: Bitcoin. Imagine waking up one morning to find that a significant portion of your life savings has vanished. This nightmare scenario became a harsh reality for many during the 2008 financial crisis. People who diligently saved and entrusted their money to banks saw their dreams shattered as the system they relied upon crumbled. This event exposed the inherent fragility of traditional finance, a system built on centralized control and vulnerable to human error and greed. The 2008 crisis served as a stark reminder that our financial well-being is often at the mercy of forces beyond our control. Government policies, reckless lending practices, and opaque financial instruments can have devastating consequences for individuals and families. The sense of security that many associate with traditional banking can quickly evaporate when the system is shaken to its core. This experience left many questioning the very foundations of our financial system. How could something so seemingly stable collapse so dramatically? The answer lies in the centralized nature of traditional finance, where power is concentrated in the hands of a select few institutions. This concentration of power creates systemic risks, as the failure of one institution can trigger a domino effect throughout the entire system. The 2008 crisis was not an isolated event. Throughout history, we have witnessed countless examples of financial crises and currency devaluations that have wiped out savings and eroded purchasing power. From the hyperinflation of Weimar Germany to the more recent economic turmoil in Venezuela, the consequences of centralized financial systems are undeniable. These events highlight the urgent need for a more resilient and equitable alternative. The traditional financial system is built on a foundation of centralization. Central banks control monetary policy, setting interest rates and dictating the supply of money. Commercial banks act as intermediaries, facilitating transactions and managing accounts. This centralized structure creates a number of vulnerabilities. First, it gives governments and central banks enormous power over citizens' financial lives. They can inflate currencies, manipulate interest rates, and impose capital controls, often with little transparency or accountability. This can lead to economic instability and erode trust in the system. Second, centralization makes the system susceptible to single points of failure. A major bank collapse or a cyber attack on a central bank could have catastrophic consequences for the entire financial system. The interconnected nature of traditional finance means that a crisis in one part of the system can quickly spread to others. Finally, the centralized nature of traditional finance creates barriers to entry and limits access to financial services. Opening a bank account, obtaining a loan, or sending money internationally can be expensive and time-consuming, particularly for those in developing countries or marginalized communities. This lack of access perpetuates inequality and hinders economic growth. The limitations of the traditional financial system have become increasingly apparent in the digital age. The rise of the internet and mobile technology has created a demand for faster, cheaper, and more accessible financial services. Traditional institutions, burdened by legacy systems and bureaucratic processes, have struggled to keep pace with these evolving needs. In the aftermath of the 2008 financial crisis, a revolutionary technology emerged: Bitcoin. Created by the pseudonymous Satoshi Nakamoto, Bitcoin is a decentralized digital currency that operates independently of governments and financial institutions. It offers a fundamentally different approach to money and finance, one that empowers individuals and promotes financial inclusion. Bitcoin transactions are recorded on a public, transparent ledger called the blockchain. This distributed ledger is maintained by a network of computers around the world, making it incredibly secure and resistant to censorship. No single entity controls Bitcoin, and no one can manipulate the supply of Bitcoin or reverse transactions. Bitcoin's decentralized nature addresses many of the flaws inherent in traditional finance. It eliminates the need for intermediaries, reduces transaction costs, and increases access to financial services. Bitcoin empowers individuals by giving them direct control over their money, free from the interference of governments and banks. Moreover, Bitcoin's limited supply, only 21 million Bitcoins will ever exist, makes it a hedge against inflation. Unlike fiat currencies, which can be printed endlessly by governments, Bitcoin's scarcity ensures its value can't be diluted by reckless monetary policies. This makes Bitcoin an attractive store of value for those seeking to preserve their wealth over the long term.